Hello everyone, and welcome back to Investment Research. I'm Simo, your equity research analyst, and today we're doing a classic showdown for three ETFs, which are Vanguard S&P 500 ETF, and iShares Core S&P 500, and SPDR S&P 500 ETF Trust. When you think about investing in the broad US stock market, three names probably pop into your head almost immediately: VOO, IVV, and SPI. They all track the S&P 500, but are they truly identical? What if the nuances matter more than we think? Today, we are breaking down these three absolute giants in the ETF world, doing a head-to-head comparison to uncover any differences that might influence your choices. So let's get right to it. Imagine you're looking to invest in the pulse of the American economy, the S&P 500. You've heard these names: VOO, IVV, SPY, often used interchangeably. But as an astute investor, you're asking, are they really the same? Which one should I pick? This is the exact question we're tackling today, using clear data to help you find the right answer for your portfolio. Let's meet our contenders, starting with VOO, the Vanguard S&P 500 ETF. For so many investors, VOO is the go-to, often the automatic choice for getting broad exposure to the US stock market, and frankly, there are a lot of very good reasons why. So what exactly is VOO? Well, think of the S&P 500 index as the main barometer of the entire US economy. It tracks the 500 biggest American companies, picked to represent various sectors. VOO's job is incredibly simple but profoundly powerful. It just buys and holds all 500 of those companies, aiming to perfectly match the index's performance. There's no fancy stock picking here. It's all about capturing the growth of the entire market. And here's one of its biggest selling points. VOO is ridiculously cheap. Its expense ratio is a mere 0.03%. That's practically free. It means almost every penny of your money is actually working for you, not getting eaten up by fees. And with massive assets under management, you know you're investing in a fund that is huge and trusted by millions. Now let's bring in our second contender, IVV, the iShares Core S&P 500 ETF. IVV is another behemoth in the S&P 500 tracking space, managed by BlackRock, one of the world's largest asset managers. Like VOO, its primary objective is to replicate the performance of the S&P 500 index. It essentially owns the same basket of 500 large-cap US stocks weighted by market capitalization, meaning the biggest companies have the largest influence. What often draws investors to IVV is its competitive pricing, mirroring VOO very closely. Its expense ratio is also just 0.03%, making it an equally cost-effective way to get broad market exposure. It's also incredibly liquid with high trading volumes, which means you can buy and sell shares easily without significant price deviations. So if you're looking for an alternative to VOO that does essentially the same job with the same low cost, IVV is a very strong candidate. The key difference here really is the fund provider, offering investors a choice between two giants in the ETF world. And now for our third heavyweight, SPI, the SPDR S&P 500 ETF Trust. SPY is often seen as the original S&P 500 ETF, having been around the longest, launched way back in 1993. It's managed by State Street Global Advisors. Like its counterparts, SPY's goal is to track the performance of the S&P 500 index. However, there are a couple of notable differences that often come up in discussions. While still very low, SPY's expense ratio is slightly higher than VOO and IVV, typically around 0.09%. Now, that might sound like a small difference, but over decades, even a few basis points can add up. The real distinguishing feature for SPY, in my view, is its incredible trading liquidity. Because it's been around for so long and is so widely used by institutional investors, traders, and fund managers, SPY boasts some of the highest trading volumes and tightest bid-ask spreads of any ETF on the market. This makes it a favorite for active traders who need to get in and out of positions very quickly and efficiently. So, while it's tracking the same index, Its slightly different structure and much higher liquidity cater a bit more to active trading strategies compared to the more buy and hold focus of VOO and IVV. Okay, we've met the contenders. We know their strategies. We know their game plans. Now for the main event, it's time to stop talking theory and start looking at the cold, hard numbers and practical implications. When we compare VOO, IVV and SPI, what really jumps out? First, on expense ratios, VOO and IVV both charge a mere 0.03%, while SPI comes in slightly higher at 0.09%. Now, for a long-term investor, that difference of 0.06% per year might seem tiny, but over 20 or 30 years with a substantial portfolio, those basis points can add up to thousands or even tens of thousands of dollars. It's a subtle but significant drag on long-term returns. Second, let's consider trading liquidity and spreads. This is where SPY truly shines. Because it's so widely traded, its bid-ask spreads, the difference between the buying and selling price, are often incredibly tight, just a penny or two. VOO and IVV are also very liquid, don't get me wrong, but SPY often has the edge for institutional traders or those making very large, frequent transactions where every fraction of a cent counts. For most long-term retail investors, this difference is usually negligible. Third, the fund structure, VOO and IVV, are structured as open-ended funds, which means they can create or redeem shares to meet demand, helping them track the underlying index very closely. SPY, on the other hand, is a unit investment trust, UIT. This structure means it generally cannot reinvest dividends immediately within the fund. Instead, it holds them in cash until distributed. This can sometimes lead to a tiny, almost imperceptible tracking error compared to its index, as VOO and IVV can reinvest dividends more efficiently. Again, for most investors, this difference is very minor, but it's a technical distinction. So, after breaking it all down, what's the verdict? Who won this showdown? Well, here's the most important part. The best ETF isn't about which one had the highest number in the past, or even which one is technically superior in every aspect. It's about which one is the right tool for your specific job, for your goals, and for where you are in your life. Think of it this way. If your main focus is on long-term buy and hold investing, and your goal is to maximize your total net worth by simply tracking the S&P 500 as cheaply as possible, VOO or IVV are likely your champions. Their identical ultra-low expense ratios make them incredibly efficient choices for accumulating wealth over decades. For most investors, the choice between these two comes down to personal preference for the fund provider, Vanguard or iShares. However, if you're an active trader or if you're a large institutional player that needs the absolute highest liquidity and the tightest bid-ask spreads for very frequent or massive transactions, then SPY might be your preferred vehicle. That slightly higher expense ratio is often a worthwhile trade-off for its unmatched liquidity in those specific scenarios. The big takeaway from all this, in my view, is that while they all track the S&P 500, these ETFs do have subtle differences. For most long-term investors building wealth, VOO and IVV offer slightly more cost-effective options due to their lower expense ratios and fund structure. SPY, while a pioneer and incredibly liquid, comes with a slightly higher fee, which primarily benefits those with very specific trading needs. Ultimately, all three are excellent ways to get exposure to the S&P 500. It really boils down to your investing style and how often you plan to trade. I hope this comparison gives you clear insights into researching further and making the best choice for your portfolio. I am Simo, your equity research analyst at Investment Research, and I truly hope this deep look gives you clear ideas to research further. Thank you so much for tuning in, and I look forward to seeing you next time for more insightful research.